Hello, this is Siwin Yi, and today I'm going to talk about a Redfin report. The title: Investors are buying roughly half as many homes as they were a year ago. Right? So let's dive in to see the big picture. And throughout this presentation, I'm going to potentially refute the alleged data. I'm going to counterpoint a lot of things that are said in here. Why? I myself is a real estate investor, more than 30 years of real estate investing experience. And furthermore, I have guided hundreds and hundreds of real estate investors from throughout the country to buy cash flow properties in the prudent markets in many areas in the Midwest and the South and the Southeast, in many markets where we have teams available in those markets to help people buy remotely, passively, mainly single family homes over the years. This article is in alignment with what I've been doing for these years. Let me see what Redfin are reporting. And again, I'm going to share my real life on the ground experience over years to potentially refute any information which I feel are inaccurate or misleading on this Redfin report. Right. So without further ado, let's go ahead and begin. Oh, by the way, I have a slideshow after this Redfin article to share to validate and confirm from my perspective. I always have proof of data. All right. Investor purchases of U.S. homes fell a record 45.8% year over year. Of course, fourth quarter as high cost of borrowed money and the prospect of substantial home price declines made real estate investing less attractive. The second biggest decline occurred in 2008 when investor purchases slumped 45% during the subprime crisis. This past year, 2020, has seen the lowest decline percentage-wise in investor purchases of single-family homes since the last crash in 2008. We're talking like 15 years ago. As you can see, during the aftermath of the housing crash in 2008, we have seen right here, which is right here, we've seen a pretty consistent investor purchasing single-family home throughout the following 15 years, with the elevation, especially 2021, when everybody and their brother are buying homes, primary homes and investors' homes back in the 2021 historic house have skyrocketing. For any given year, all the inventories out there, investors typically have purchased almost 18% of all homes that were bought into the metro markets. The Redfin cover, I believe, 40 of the largest metros in the country. Even or not doing all the surveys of all the metros in the country, I think that would agree on soft in terms of complete accuracy of their information and the data as reported on this article. Okay, as you can see, I will define the definition of investor to you momentarily, but for the past 20 years, investors have increased the percentage of holdings of all home purchases year over year for the past 20 years, especially at the peak, it came down from the peak of 2021 until now 2023. As I mentioned, a Redfin track on this data, 40 of the most populous U.S. metros in the country. Here's the most important definition. Investor is such a broad, generic topic. Redfin defines investor as on this article as any institution or business that purchases residential real estate. That kind of tells me that they're probably referring to the Wall Street, the hedge funds, the institutions, and the large hedge fund investors that, in case you have not heard, they have purchased many communities in the red hot Sunbelt destinations in the past few years, where they buy the whole block of communities of 100 homes and 1,000 single family homes and they rent it out to to renters. So it's a sort of a build to rent business model, if you will. They focus, because I will show that later. Investors, or they want the Wall Street institution investors, they want a large piece of the pie. Right now, they have a very small piece of the inventory pie, around 5%. But in the next 10 to 15 years, the projection are the Wall Street hedge funds and institutions, the corporates, landlord, they could have a much larger pie, around up to 20% or more in the next 10 years. You guys out there, so they are competing. Wall Street corporate institutions, they are competing against primary home buyers, first time home buyers, and regular mom and pop investors, the people I work with, my organization. Everyone want a piece of the single family home residential investment pie. It's all about competition. Just give you a warning as you look into the future, what you're up against. So there's a lot more competition down the road because everybody and their brother wants a single family home house, to especially entry level, which is very hard to get because most builders, most of the national builders, for the past few years, they have not been constructing entry level homes, anything that's under $300,000, for example, anywhere in the country. Very hard to compete against the limited type of entry level homes. So just so you know, everybody wants this, right? Let me get back to the article here. Home price declines prompt investors to back off. Investors are no different than regular primary home buyers. These interest rate sensitive type of decisions that they're making. Investors piled into the housing market in 2021, just like everybody else, due to the rock bottom mortgage rates and surging housing demand, and are now retreating amid projections that home prices have room to fall. Anyway, so many investors are moving their money into other asset classes that offer better returns. Again, I'm going to refute this allegation. So I believe single family home residential investing still are very attractive numbers wise and returns wise. I'm going to prove it to you momentarily. For investors who are landlords, slowing rent growth is also making it more challenging to reap larger returns. Once again, I have a very different opinion. Slowing rent growth, yes, rent growth has been stabilizing, but the rent growth nationwide in 2021 and part of 2022 in certain sun belt market like in Florida and Phoenix, Arizona, and Las Vegas has skyrocketed 20, 30, 40% rental rates increase during the pandemic. Right now has subsided, obviously. It can't sustain itself. But to say that rent growth is continuing to go down, that is misleading and inaccurate. Redfin. Also, a lot of those rental rates data or the survey was done on multi-level apartments and multi-units. There are very few organizations that have the ability to research and study and calculate rental rates increase on single family homes. Just want to keep that thought, okay? I know what I'm talking about. All right, so let's continue. When it has subsided, yes, single family home investing, especially in fast growing markets like in Florida and Texas, and even in the Midwest and the South and Southeast, the rental rates right now moving forward is going to increase relative to inflation. That's how it goes, right? Historically, this always has been the case. Rental rate increases coincide with the normal inflation that we are seeing year over year. So, all right. So it is possible that investors will start to way back into the market this year, given the mortgage rates have ticked down from 2022 high, especially if home prices show signs of bottoming. According to Redfin senior economist Shahriar, he goes further to say it is unlikely that investors will return with the same vigor that they had in 2021. That's good news for individual buyers who are still grappling with high housing costs, but no longer losing bidding war after bidding war to investors. Investors have bought 48,000 homes in the metros, a track by Redfin in fourth quarter 22, down from 89,000 a year earlier, and down from 60,000 in the fourth quarter of 2019 before the pandemic, as you can see. Yeah, really, the investors' transactions are really no different than primary homeowners. It is still affected by the interest rate. And I'm not going to cover too much over here because I've talked about it. You learned about it. Pandemic boom times see the bigger drops in investor purchases, no different than primary home buyers. We're talking the typical boom town to bust town, right? Phoenix and Atlanta, Charlotte, Jacksonville, Sacramento, Riverside, Orlando, and pretty much the entire western region of the U.S. So many of them are only offering around some of these hedge funds, corporate landlords, they are offering 60% of the asking price. You're not going to get that right now. That's too low since it is difficult to make a profit when flipping homes right now. That is true. Flipping is not the best strategy at this moment on a correction housing market. Bring 60% of the asking price, that is a tall order. I don't believe sellers or builders are willing to do this. Only time will tell. With the largest declines in investor home purchases or typical Las Vegas, Phoenix, Atlanta, Georgia, Charlotte, Jacksonville, Sacramento, Riverside. Investors lose most market shares in Atlanta, Charlotte, and Phoenix. So purchases of single family homes sink 50% more than any other property type, single family homes. I disagree. I'm showing you why right now, even with the higher mortgage rate, investors, at least my mom and pop regular investor, they should still plunge into it right now. But you have to know where to strike. You have to know what neighborhood, what market, what sub-market, and those kind of things. Disclose as much as I can during the remaining few minutes of this video. So, okay, now, but they'll come back, right? Investors can come back once the interest rate subside a little bit this year. Those mom and pop investors come back. Those Wall Street hedge funds, corporate landlord, they will come back and buy in bulk, and they take a lot of the inventories away from this first-time home buyers, which is sad. There's a lack of inventory, lack of homes everywhere as we speak. Okay, let me see. I think that's all I need to say on the portion of the article. But I'm going to share with you. The slideshow that I produce, which will prove some of the things that we're going to be talking about. Again, because of the higher mortgage rate, just transpired around 6.8% a few days ago in February. There are still some segment of the housing market throughout the country. We're still seeing a little bit of a bidding war, a little bit of multiple offer, not the crazy things that happened in 2021. Let me give you an example of a local realtor that I know very well here in San Francisco Bay Area where I live. And this 3 listings just was happened I think last week. And his listings or in Fremont, California, that is San Francisco Bay Area, this home was listed for 1.58. It was sold $180,000, I think, above asking, right? And there are several offers on the table. And another property was listed at 1.5 million. It was sold at $125,000 above asking. And this one was listed at 1.25 million. It was sold $101,000 above asking. This is a small sample. I know the beginning of the year, there's a lot of housing activities every beginning of the winter season. Things has been the trend. we will see down the road, next few months, what's going to transpire, especially when the mortgage rate is reaching almost 7%. The second thing I want to talk about is now for anybody to say the Wall Street landlords, as I mentioned, they have already stockpiled $110 billion lying in waiting for the biggest American home buying spree yet. See what I'm saying? See what's going on? They may have a pullback right now, as I've stated, 46% pullback. But hey, who's to say with a mortgage rate or decrease, hopefully this year to a less than 6.5% to maybe a 6%, this Wall Street landlord with the big buck, they are coming back because everybody's coming after single family home residential investing, not just the mom and pop investors that I work with, that many of you are listening to me, hopefully. Again, there's no crash, in my opinion, because the inventory of homes are still at a historical low, extremely very low. So where the home prices fall, you can read it all on your own, mostly in the West Coast, California, and few other places on the western region of the US. And there are other places. You can read it yourself. I'm not going to go there. Now, some of you are thinking, all these boom towns, the Austin, Texas of the world, Phoenix, Las Vegas, and Boise, Idaho, there has been substantial correction, 10 to 15% reduction of prices, especially in the past 6 to 7 to 8 months. So that's what's happening. Some of you are thinking, look, some of you are thinking these kind of boom towns that have skyrocketing of home prices, or mainly as a result of the people of migration, or people that are migrating into these boomtown areas in the past couple of years during the pandemic because of remote work. And these people migrating mainly from California and from Northeast, right, into these cheap boomtown areas, the Sunbelt areas. And these people have more income. They are high tech, perhaps. They are highly compensated individuals. They're able to bid up the home prices in the past couple of years. Some of you are thinking, oh, the market's going to crash. This boom time is going to be a boom. It will be a bust time, right? And yeah, we have seen some reductions of prices. I clearly understand that. Now, I'm going to show you some data that we will determine. No one knows for sure what's going on. No one have a crystal ball, but let me show you some data or what I'm talking about. Let me share back the screen here. Now, if you look at the where one of the way to track in the next few years about migration, I'm sure you agree, all the locals that have living in these boom towns, Florida, Texas, Boise, whatever, and Phoenix, Las Vegas, to name a few of this boom town, the bus town, all the locals has been priced out. We agree, right? The locals cannot afford these elevated home prices. All the out of towners or people migrating into these areas, or they are bidding up, getting these homes to live. They come in these local areas to live and to invest. I get it. If we look at in the future, if you use the U-Haul tracking, okay, to determine some of this, there are many companies are doing hybrid working. So they are asking some of their employees to go back to work physically. So they are no longer able to work remotely. That could be a problem, right? Because these migration people, they have income to support the elevating home prices. But if they had to go back to their home state, I'm not saying a lot of people will do that. It's a hybrid working environment. But if you see a more and more trends of people or ordered by the employer to go back to California or go back to Northeast, wherever they came from these boom towns, we may see some prices being reduced because they have to sell their homes. They have, to go back where they work at. You know what I'm saying? So things remain to be seen. By looking at the U-Haul, you will see where the people are still migrating into this boom town, bus town for the next few years. Time will tell. And the home prices is a reflection because right now, I'm sure you'll agree, the income and wage growth have not kept up the skyrocketing home prices. And if those high income earners have to leave town to go back to their original destination where they came from, we can see continual house corrections and reductions. By the way, feel free to make a comment below when I finish with this video. And of course, smash the like button if you see value in this video, and also subscribe to my YouTube channel, and also subscribe to my email or my real estate investment network. You'll receive real estate investing information as well. Free, okay? Keep tracking right there. Areas are growing. Once again, just the same area, Florida, Texas, and the Western Sun Belt as well. And so watch for these kind of trends, top areas of people moving from, and the top areas where people move into. Here are the listing. I'm not going to go over them, but suffice to say, this is the trends of very important. The top 10 metros in the US with the fastest growing sales price. Guess what? 5 of them are in the top 10 or in Florida. By the way, I continue to guide my real estate investors, mainly from California, to buy investment capital properties, entry-level homes in Texas and Florida and a few other places. And then now I'm gonna finish up with some. I told you that at the beginning of this video that I'm going to go over. I'm going to review some of the Redfin data, why investors should not exit the market, because if you know what submarket specific neighborhood to buy as an investor, you can still make higher returns. For Redfin to say that investors are entering into other asset classes, what other classes that can do better than single family home investing? Okay, I will prove it to you momentarily. I know we have a lack of time. I can only do a fulfillment minutes. This is a pro forma, if you will, as an investment property. You buy in a good market like in Florida, $325,000, ready for $2,600. Even with 6.5% or 7% mortgage interest rate, you can still cash flow. It's all about cash flow. Investors buy for overall return, not just cash flow. Investors buy for cash on cash return, capitalization rate, and total ROI as indicated on the upper right hand corner. It's just people, savvy investors, let alone new investors, they do not have to calculate ROI. It's not only about the first year projection. I'll show you from a big picture. I could talk for 2 hours to discuss these numbers, but I'm not. You can freeze the screen and look at the numbers. Why investors should not exit. A whopping 46% reduction of investors exiting the market temporarily. No, you have to invest for the long term. You buy the cash flow, although the first year cash flow may not be all that great, but you have to think long term. How? Before you do that, I say this on my other videos about investing. Rental property, income property, single family home investments. It is history's most attractive, powerful, and proven multi-dimensional real estate investment asset class, because you make money 5 different ways: cash flows, passive income, rental rate increases, tax benefits, appreciation, equity growth, and using leverage of a 30-year fixed rate mortgage. And all you gotta do is put down 25% down payment. So here are the next 10 years. People do not know how to calculate the increasing yield, the increasing internal rate of returns as they continue to own a rental property year over year, over years. I'm not going to go over the detail. It'll take me 5 hours to do this, but you can see on a year-to-year return, when you increase your rents 3 to 5%, whatever, and when you increase your the cash flow, it will increase the invest tenant going to pay down your loan. You're going to have a more equity down the road. Rental rate increases, equity appreciation increases, maybe a decrease from time to time, but it doesn't matter. As long as you cash flow, you're making money. But as long as you have a good rental market, fast growing market, you have to find the right marketplace. I get it. But if you look at this now, so it really is too much to say. I refute the data, although it's no, it's good information. The Redfin we're talking about this, but at the end of the day, be fearful when others are greedy, and be greedy when others are fearful. Warren Buffett said that. My takeaway is this: investors, there's no need for you to wait on the sideline. Primary homeowners, I understand. Understand it's all about mortgage payment. If you cannot afford the mortgage payment based on the mortgage rate, then you can do it. You either buy a lower price home or stay in the sideline or wait, whatever. But investor, there's always opportunity to when all the crisis is going on. Then you find the right market, you buy low price, affordable markets in South and Southeast and in the Midwest. You surround yourself with a good team. You do the numbers. If you cash flow from day one at 25% down payment, then year over year, you calculate all the multiple dimensions of a rental property. Then what you learn about this concept, which many experienced investors have not been taught about this, what I just shared with you, and you would not be one of those investors that are waiting the sideline. And all those investors that entering the market temporarily, 46% reduction of investor purchases, they don't know what they're talking about. The hedge funds, I don't know. I don't know what investment methodology they are using, or whatever it is. I will consent them if need be. Why? Why are you exiting? If you go to the right market with the right numbers, with a lower price entry level homes, you compare that to the rent. If you go to that fast moving market, population growth, job growth, you should not be exiting the investors market. That's all I'm saying. You invest over time, you invest for the long term, and all the numbers will do well for you. Anyway, hopefully you have a good, hope you receive a lot of value from this presentation. If you have, please smash the like button. Sorry. And of course, subscribe to my YouTube channel and also subscribe your email into our real estate investing community website. The link right below you, and you will receive the general real estate housing market information on a weekly basis from myself and also real estate investing information. Thank you so much for listening. This is Siwing Yi, and I will see you on the next video shortly. Have a nice day. Bye bye.